to another investor to see and what their approach was to us. And
Right.
it was, gosh, I can't remember the name of the company. It was Reliant. And just
What's Reliant?
they're syndicators, and we just want to see what their pitch was to us. So we try to copy and see how these guys. They were more like it's of course boutique, and they're a little bit more. You can invest with us, or you don't have to. We don't care. That's
Oh,
that line. We were like, wow, this is totally different, and we had
yeah.
their spill too, and a lot of the questions they had to, and they were trying to explain some of the stuff. Some of the stuff I understood because you coached us already and taught us with some of the videos, but some of the stuff they were talking about, which I didn't know, but I just shook my head because then I'll ask
Right,
you
right,
about it
right.
later.
Right,
But
right, right.
yeah,
Well,
that's
I
one thing
think
she
I
was
think I
quizzing.
think there's two things. If you're meeting with potential investors and you don't have a deal that you're actively raising capital for, then you're really just telling them about your company, telling them about what you do, what you plan to acquire, how investing passively in multifamily or other types of real estate benefits them from a tax perspective and from um, just from a diversification perspective and from a cash flow perspective, right?
Right.
So you can nurture those relationships just generally when you meet investors, and I think you should have that elevator pitch kind of ready to go.
Okay.
But then when you have an actual deal that we're raising capital for, we'll have a pitch deck already ready to go, and that pitch deck will be circulated to your investors. And so really it's about answering questions that may be related to that particular pitch deck that they may have.
Okay.
And then what we would likely do is do a webinar. And a webinar is the best way to really raise capital because it's a targeted 30 to 45 minutes about the deal. You get an opportunity to raise, people can raise their hands and ask questions. And that's really where you can get a lot of traction from investors. Yeah, from investors that way is through a webinar. But
Okay. So
but
you help us along that way
oh,
too.
absolutely, yeah. So
But we want to
we'll
be
help.
prepared too because our clientele, half of them won't speak English.
Yeah, so you might need to prepare the pitch deck
Yeah.
in Korean, right? Korean, right? Is that
Yeah.
right?
Absolutely.
Yeah,
Yes. Yes.
yeah. Prepare it in Korean, and then you know, have if you need to have a webinar in Korean, that's fine. I'll just get a translator or listen in or something.
And one of the things he did say about their financing is the depreciation. By what K, I believe.
Say again.
Depreciation by K is it 168K?
Are you talking about the actual tax code
Yeah,
section?
yeah. He said we would be able to because we're quizzing him just to see how our approach would be if we were actual clients. And he said one of the tax benefits would be K. And I hope you understand that. When we looked at it, he just went beyond it. So we did stop. So I was going to ask you, do you know, did I
Yeah,
not get enough
168. Yeah,
information?
168K is the bonus depreciation
Okay.
provision.
Okay.
Yeah.
So that's something where he assumed that it was like some sort of big news for us, that it was good news for us. But that's why I was like, okay, then I just want to talk to Todd about that.
Yeah. That is now let's hope to God that, whatever you think about Trump, he's going to reverse that because right now it's, in 2025, we're only supposed to get 40% depreciation, right?
Right.
It was at 80 in 23 and then went to 60 in 24, 40 in 25, 20 in 26, and then 0 in 27. But I think Trump will revise that or unwind it because
Can you just real quickly, then we can have the whole group explain that to me?
so what bonus depreciation is?
Yeah. Yeah.
So when you guys buy properties, you're going to do what's called a cost segregation analysis. And you're going to hire a company to do that. It's like a quasi accounting firm that does it. And what they do is they go in and they will allocate the value to the land and the building, right?
Okay.
And pursuant to the IRS tax code, and this is just pursuant to, any sort of physical assets, the tax code allows you to depreciate that because when you use a building over, a 20-year period, it's going to deteriorate. And when it deteriorates, the value goes down.
Okay.
right? So the tax law allows owners of buildings to capture that loss in value through depreciation. Okay.
So it's a tax benefit for us. And right now we get a 40% tax benefit.
Absolutely. Yeah.
Okay.
So what happens is if someone invests, like $100,000 with you, even, their capital account is positive, and say they got, 6 months of distributions. So typically their capital account would have a positive, they would pay taxes on the money they received from their distributions, right?
Okay.
Well, when the property has gone through a cost segregation analysis, that analysis is then provided to the company, to the accountant. And if they say it's a 5 million, say in Dante's perspective, it's a $5.4 million building, and we do a cost seg, and the land is worth $2 million, and the improvements, right? The legal term is improvements. That's what you call anything built on top of the land. The improvements are worth $3.4 million. So that value of $3.4 million, you actually take as a loss. You would take 80% of that. And so it's a little bit of a tax code shelter, what we call a tax shelter, right? But kind of a loophole because even though the property has not lost 80% of its value, you are reporting to the IRS, that you're taking a loss because your investment has lost value because of the depreciation.
Okay.
Right.
So the money invested, let's say if I invested 100,000, if I was an investor and they said right now the tax code is 40%, how does that, does that mean 40% of what I invested, or?
I think, yeah, well, it's 40% of the, I don't know. This is kind of straddling the limits of my knowledge, because it's more of an accounting mechanism. So we need to talk to an accounting expert.
Well, I feel so much better than that. It would be something simple. The guy told us, like, everyone should have known, like, oh yeah, the benefit of the 168K, that this investment, you get to save so and so. I was like, okay, great.
Yeah, it's not quite for, like, I was thinking about one. I invested in a deal in South Carolina passively, and it was $100,000, and I got my first year, I got like my K1 was like negative $17,000. Even though I received distributions and I have a positive capital account balance, I get a deduction, and I receive a negative K1, so then I can offset that from my passive income. Right. So when you're talking to investors, that's the big sell is, hey, you can deduct, you can get depreciation and ratchet or gather passive losses on these properties, even though you're getting income.
See, that's where I really need to sit. I hate to bother everybody with this. I do need to sit down with you, because in order to get to that point, there's a bunch of people who want to, my clients, and Haley put me on the spot, and they are, why should I not buy a home and just keep it for myself and invest, put up 500,000 and pay in cash instead of investing with you, because they're W-2 people, and I need to explain to them, I need to have some tax benefits instead of like doing, rental. That's how I'm going to sway all these guys. And she had that little thing too. Are you ready to sway people? And I was like, kind of, but then it got the curveball. So I want to talk to you about that too. And also, I won't hold everybody up. So let's class start. Dante, thumbs up, man. Congratulations, buddy.
Oh, he's on mute.
That's right.
Yeah, appreciate it. Thank you so very much.
There he is.
Yeah, I'm here.
I don't think I've ever seen you without a hat on. So,
me neither. Yeah. But that's a good thing to talk about, like cost segregation.
Cost segregation. It's a huge thing. Now here's the other thing. Here's the other piece of it. You can only, so IRS section 469, okay, basically says that passive losses can only be offset from passive income. So if you have investors that are receiving passive income, from properties or from other investments, right? They're receiving passive income. That's where the depreciation will really benefit them, because they can offset that capital gain or that taxable event by the depreciation. So So the other thing is you can if the passive losses exceed your passive income, right? Then they're technically called suspended losses, meaning they can carry that loss forward indefinitely until you generate enough passive income. But that so really for the okay, so this is the other exception. There's an exception for what's called real estate professionals. So like Johnny, you would qualify as everyone on this call would qualify as a real estate professional. What is a real estate professional? That is a professional that works at least 750 hours per year in real estate, and 50% of the work is in real estate. So if that is the case, then you can deduct depreciation losses to offset what we call active income. Active income is from your W-2 business. Right. So if you've got investors that are W-2 earners, say they're doctors, right? They may not qualify as a real estate professional. And so they may not be able to benefit from the depreciation. However, most, if you have a friend that's a surgeon and the surgeon owns a bunch of real estate, but he also practices medicine at Grady, right? It's really up to his accountant whether he wants to be designated as a real estate professional or not. I mean, it's really like a check the box thing. But the IRS has, if they've come and they have come and audited. There's one really famous case. I read it when I was in tax school, but it was this executive at Coca-Cola was designated himself as a real estate professional, even though he had enough hours to designate as a real estate professional, but his primary job and gig was at Coca-Cola, so they discounted his designation, if you will. So, but that's a good point though. Understanding those differences between, active income, passive income, who can qualify for depreciation. If you're talking to people who are investing in real estate and they're an active investor, they've got a bunch of properties, 9 times out of 10, they're going to be real estate professionals. So good question though. Yeah. And that's why, Johnny, that's why I was thinking once the website is done, I think Eugene's working on it. He just joined, it'd be good to get like a general like company profile or company pitch deck together that may not be deal specific. That kind of just tells people, hey, this is what we do. This is what we're investing in. These are the markets we're focused on. These are the fundamentals that we find important. Things like that.
Todd, speaking on that too, I mean, one of the things I look at is after meeting with these people or in general, I mean, you could have the best pitch in the world and I'd like to give a shot to somebody I know, but if you have no credentials of doing something beforehand, it makes me a little bit more apprehensive. Like, I don't want to be your first person, to be honest. Do you see what I'm saying? So that's the reason, one of the things I want to talk to you about was, of course, everybody on this team, and we can link and use you as a referral.
Right. Yeah.
Or
use me as, put me on your pitch deck as part of your team, or, your advisor.
That way we can see your credentials on there, saying like, here's some of the stuff too. We keep it quiet. And that's the same thing. That's what Haley likes to work on mostly is, some of our clients are, people who are in the spotlight, and you got to keep quiet about it. So that way we don't discuss who's on the, who have you done before, but we can show that stuff that Todd has done, and we work with Todd. So it makes it look like that. That's why I wanted to ask.
Yeah. Yeah, I'm fine with that. Yeah, you can add me to your pitch deck as, advisor or whatever, board member or whatever you want.
We're going to put your headshot on there too, Todd.
Yeah, put the headshot on there. Put the whole deal.
It's recorded. Dante, you're next, man.
Who, Dante? Yeah.
Oh yeah, we can do that. You can do that. Hey, I put Todd on my website, man, just because, hey, he's my mentor. He's part of the team. He's the one that's advising us. So
hey, Dante, in the group chat, text us the web address, so we can take a look to see how you did it, if you don't mind.
Yeah, no problem. Looks good.
And we can all link each other too as a big group too. I think that would really help stir and say like it's just not just a couple of people. We're a bigger group, and that's what we're trying to stimulate, I guess, with our clients.
Yeah. Yeah. Awesome. Awesome. What else is going on? Any other questions? We had a couple new folks join the school platform. I actually I kind of opened it up to see if we would get some more interest, and we have. So I just, people join, but they don't take advantage. So that's all right. It's up to them. What else is going on, friends?
Let's hear about Dante's. Where are we with this? Yeah.
Well, Dante, you want to kind of explain what we did yesterday?
Just put it up under contract. Finally, after a couple weeks, it was good to slow it down.
Yeah,
and things like that. So
I slow played it on purpose.
Yeah, I'm grateful for that, because I was over here sweating. Trying to get some money together for the earnest money and everything like that. And so now that it's under contract, it's like quiet and just gotta, do what is needed. So
is it okay to ask for details? I mean, what was the asking price, and what did you put it under contract with?
Oh, so the asking price was 6.1. It's a 59 unit townhouse style apartment complex in Milledgeville. Put the LOI in as a 5.425. So basically about $600,000 haircut.
And was that multiple times of back and forth to getting to that price?
No, it didn't. It actually all just happened at once because Todd already knew the broker. He hit the broker up, and the broker just said they were offering a certain amount of money at that. And what I already did, my underwriting was already a little bit over theirs. So
okay,
yeah. So they
so you got it less than what you thought it should be. Then, if it was a little bit over, you said, right?
Just a little bit over. But with the rent rolls and everything coming in and seeing everything, we might get some concessions to, we'll still be getting it for 5.4. But we might even do a retrade too.
Is this near Lake St. Clair, or is this near the Georgia College and State University?
No, it's literally right next to Lake St. Clair.
So your clientele would basically locals more so than the students.
Yes. The locals that are there in that area, and then basically it's all blue collars.
And what was the occupancy rate?
Occupancy rate right now is at 84.
Well, that's high. And what about the renovations? What percentage is renovated?
Basically nothing is really renovated. They got 2 units that they made into corporate rentals. So those are going like 2 times more than the market rate is. They got 2 furnished those. And then when we walked through, there was 9 of them empty. We only walked through about 4 of them at that time. And when I looked at them, they're not upgraded. And so
now, let me
go ahead.
Now, let me ask the Todd question then. I mean, at what point did Todd jump in there? Like, all right, I got my underwriting done. The numbers look good. Todd, this is where I'm at. My numbers are slightly higher than what what the asking is, what we're going to offer at. What'd you do at this point? Did Todd help you out with the initial application for the fee? I mean, letter of intent, or
yeah. So basically, he saw the numbers. We looked at it, saw it was a good deal, and literally, he's just say make an offer on it, and gave the the blueprint of the LOI. We walked the property. When we walked the property, we found out the LOI was a little bit, too wordy for the seller. But they just, they were anxious, so they sent it back to us, kind of scribbled up, and told us, hey, we had to change that, change this. We don't have this, we don't have that, and then sent it back out. They accepted it. And then what was it? Probably, after that was just put it under contract. And the contract.
So when are we doing the webinar to get some investors?
Yeah, so
are we
now,
doing 506B or C?
probably a B, I would think. But now, so now we're on the clock. And so Dante, what my team will do here, they'll put together the critical dates memo, which is the timeline we have to get things done. So that earnest money needs to be deposited, I think, within 3 business days. So call it by
Yeah, it said
Friday.
5 business days, but I just sent it
Oh, we
off.
said 5?
Yeah.
Yes, that's perfect. So it was under contract today. Or did I send it yesterday?
Yes, yesterday.
So the
Yesterday under
10th.
contract.
Right. So 5 business days, we've got, wait, 10 is Monday. So we've got, so 1, 2, 3, 4, 5. So by Friday, no, that'll be the next Monday, the 17th then. Because we don't count weekends.
Okay.
Because it's business days, not calendar days. But to your point, Johnny, now we're on the clock. And so, the earnest money is going to be put up. It's going to be refundable during that that 30-day window that we're doing our due diligence. So now the next stage is, we've actively been working with the lender. And I guess you're realizing, Dante, now, like, how much actual work it is to, like, put all this together, right? Put the puzzles together.
Yeah.
Because I mean,
there's a lot of invisible pieces that are going on that I had, you hear about it, but you just don't know about it, and
the invisible,
the
invisible pieces. That's a good way to think about it.
Yeah, because the insurance, you got to send something to the insurance guy, and then the insurance guy has to wait till it goes on the due diligence, and then we're going back and forth with the lender. When it was 85% when we walked it, or 86% when we walked it, it was good for the lender for the senior loan, secure long-term loan. Now, because we got a new rent roll of 84, they're saying the occupancy level is too low, so now we have to go into a bridge loan level. What I did in the very beginning was stress tested all the way up to like 8 to 9%.
On interest rate.
Yeah, on the interest rate, because when you see people doing underwriting, they're doing it at 5%, 6%, like thinking that everything's lovely. So I did it basically like at not my biggest one was at 8.7. It was like an 8.8 before it just started going downwards. And after that, we got all the loans, interest rates in. So it just made the deal look sweeter, look better. But now we're back into the bridge loan area. And then I still had meat on the bone to be able to handle up to almost 9%.
How's the bridge loan?
How is it?
Yeah.
I'm just sending back information on the CapEx budget right now. With my PM, my property manager, he's going to help out actually come up with a complete CapEx budget, and compare everything to the rent rolls and underwrite it for the property managing side. So I just sent him a mock one today. It's just saying what we can do and how much it might cost. But the real numbers are going to be coming out here in another week, in 2 weeks.
So this is that's a good point, Dante, because we were kind of thrown a curveball when this whole time we thought we were going to use the CBRE Express Loan Program. That's the program where that's like agency-like. It's basically just like an agency loan, except they'll accept 85% occupancy, where an agency requires 90. Right. And then and they took it all the way to the top, and they said, and there's a difference between there's economic occupancy, which is actual collections, and physical occupancy. Those are very, very different distinctions that are very important. And so this property, while it was like 84.5% physically occupied, it was 80% economically occupied. So they had 20% of collections or however much. So because of that, they kicked the deal. They said they can't do the CBRE Express. I did get the indication though that they would be able to pivot if the occupancy got up, right?
Yes.
Yeah. So in the meantime, we said go ahead and shop bridge lenders, and we will have to actually pay. We'll have to build in probably a mortgage broker fee now to CBRE for the bridge loan that they hopefully can bring us. And I've got tons of other brokers in my Rolodex. Like, we don't always have to use CBRE. I just know those guys really well. They're really organized, easy to close with. They got a big team. So we may want to. I may want to look at other groups, but I like using known entities like that, like big shops, because they provide a lot of value, especially like, we started getting emails from their analysts now that are asking for the CapEx budget. Like they'll start helping us package this deal to present it to the powers that be to get it closed.
Yeah. And I
So,
think that just looks better on the track record saying, hey,
yeah,
I've worked with these people before. You see, if I
absolutely.
put CBRE on the next, pitch deck, oh, I got partners with CBRE. We work with
Right.
them.
Like here's my lending partner. Yeah.
Mm-hmm.
Yeah. So, but to that point, we need to probably put a webinar together, Dante, if you think you've got some people that can attend. I haven't sent out any correspondences with anybody to get investors. I certainly can. And actually, now that we've got the pitch deck together, we need to do that.
Right.
But we need to get the webinar together, and then we need to get the unit walks done. So we need to get Brad, get on an email with Brad, loop me in, and just say, because now the next step, Johnny, is that we need to really, for everybody, we want to do 100% unit walks. So with that takes a lot of coordination with the sellers, because you've got keys, you need to, you got 59 different sets of keys and 59 different units that you're going to walk through, and it'll take all day. But you got to really understand the issues, because there could be one property that has, or one unit that has, $10,000 of mold that is growing that needs to be fixed, right? Or there could be a structural issue in one unit that no one's seen, and it causes a catastrophic problem. So,
who are you doing that with? Who are you walking around with?
I think we'll use Brad McCants. It's the property manager that was recommended to us.
Okay.
And so
he'll be the property manager for that place. So he's well abreast to that kind of stuff, to look around and say.
Yeah, he actually owns, he's actually an operator and a real estate investor, been doing it for 27 years.
Okay.
But he's actually a person that sells houses and buys houses and things like that. So he owns a property probably about 2 miles away that he's selling right now that, he's been worked with.
And how did you find him?
Found him through actually Connor, my broker. So, look for people myself, and then just called up the broker and said, hey, do you know anybody? So he sent me this guy, and I met him up in up in Lawrenceville last week. Sat down with him at Jason's Deli and talked to him over some salad, and picked his brain. And he actually has a investment service where he helps out with the due diligence and it walks everything. It does everything, like, because he's done it before, so he knows what he's looking at. So.
And he'll help us refine our CapEx budget as well. So, so he
Todd,
will.
have you worked with him before?
Have I?
Yeah.
No, I have not, but I trust Connor, and he's kind of, it's a middle Georgia market. So you don't really want somebody from Atlanta that's going to have to drive down there and manage it. So I think he lives down there. He's close by. He had some really good ideas on how to really push the rent and manage it. And I think he said he'll put a person there at first, right? And then kind of get it up and running, and then we don't need somebody full time.
So Connor's not the listing broker, right?
He is, yeah.
Oh, he's listing. So he recommend. Okay. So that's
yeah.
Gotcha.
Yeah.
Wow. Okay, so the next step is the walkthrough and everything, but I guess you're getting together with Todd and getting the webinar ready for investors.
I'll build that out. And it's just recording myself over and over again to the point.
Well, no, I think we should do a live webinar.
Okay.
All right. We'll do a live one. Yeah. We'll do a live one where people can join and ask questions.
But that's not considered advertising then? I mean,
well, it's going to be only to those people that we have pre-existing relationships with.
Yeah. People that I've already talked to. I think I've probably got about 8 people that I've talked to and told them about over the last probably like 2 months about this deal.
Yeah.
Over like last six weeks, I just say, hey man, I got something coming up. If you're interested, hey, I don't have it under contract yet, but it will be, and just let them know. So
what is their questioning when they hear about that? What do they want? Do you have a pre-existing relationship where you've worked with them before? Is it just something where I know they have money and I know they're investors, or they're not going to grill you to death on it?
Well, no, it's not that. It's just that I've been very what do you want to say, vague about it. It's I've been working in real estate for a little bit. I got something, apartment complex that I'm doing, trying to scale. Would you be interested? and looking at it. And like, oh yeah, man, what do you have? I'm like, I don't have all the numbers right now, but once I get everything down, I'll holler back at you. And a couple people, when I was trying to get up to the earnest money, I put some stuff out to them. Was like, hey, if you can give me this money real quick, this, that, and the other. They're like, well, I'm doing my taxes and things like that, so I had to go other ways to get some earnest money real quick. But they're still interested in being maybe a passive investor later on. A couple people I've met, they're like, hey, I like what you're doing, but I invested too much. So I don't have the means for that, or your deal's too small. I'm not looking to do that. Or another guy that I really like, but he's like, I just want to do retail. And if you can find me some retail, I'll jump on anything. That's what I'm trying to do.
Really
So,
interesting.
yeah.
Hey, Dante. Oh, I'm sorry.
Yeah.
I was wondering real quickly, how much was your earnest money now?
50,000.
Okay.
Yeah. Yeah. But it's what, 1% of the deal.
Exactly.
Yeah, typically.
Mm-hmm. Yeah, and then we kind of got lucky in the contract because he actually said it's refundable all the way to 60 days. So.
Hey, Todd, you don't have to have your own, it doesn't have to come from your own personal account to be the earnest money. It can come from an
Yeah. Hey, there's lots of ways to skin this cat.
Well, that's different.
It can't. One thing it can't come from, I guess, if you take cash out of it, but Dante asked me, I haven't told him.
Oh, come on.
Like, can I put this on a credit card? I'm like, I don't think we can do that.
Hey, I tried.
On the platinum, man, I like that.
Oh man,
I don't think we can do that. But if you get cash from your credit card, that's fine. But no, I mean, it can come. No one's checking. I guess the point is, no one's checking where it's coming from, right? I mean, the money has to come from the borrower, and the borrower, or the buyer rather, is an entity. And the buyer can borrow that money from someone else to put it in escrow, right? It's the buyer's risk, though, if they borrow money from somebody and then they end up blowing a date or losing the earnest money. That money now the escrow agent, like if whoever the escrow agent, like in this one, my title company is the escrow agent. We have fiduciary duties then to the seller and the buyer, so it's not like we can give the money back even though the buyer's in default. So if the buyer goes in default, the money has to go to the seller regardless. But yeah, it doesn't have to come from personal accounts. I mean, it could be borrowed funds, because once that money's sitting in escrow, it's for the benefit of both parties under the contract.
Got it.
Yeah.
Dante, how far are you from Milledgeville?
2 hours and 15 minutes.
Where in Atlanta are you again?
I'm in Kennesaw.
Okay, wow, the other side.
Yeah, it's on the other side, but that ain't nothing to me. We just sold a property in Covington. And that was it was deep in Covington, so that was nothing. I was like, okay, Milledgeville is a little bit better than Covington. So
in Covington, like in Newton County?
No,
yeah,
that's
no,
that's
is that Newton?
No,
Yeah,
Covington.
Wait, did you say you went and toured a property over there?
No, I sold a property about 5 months ago. We sold a property that we had in Covington,
off I-20.
Yeah, off of I-20, and then deep, like literally about 45 minutes in off of it. So it was deep down there, and we wanted to rent it out, and it was like, nah, for one roof, not doing that. But Milledgeville,
Covington, man.
Yeah, it was
rough
deep.
area.
So yeah, so but Milledgeville, yeah, it's right down. I feel it's right down the street, and then having Brad down there, and he's working it out to where he wants to, hey, we have somebody in there full time until we get stabilized, everything up, and then down to part time. So we don't have to have a full time property manager in there.
Yeah.
Hey Todd, how about a field trip? If their clients aren't there, if it's okay, but let's have a field trip when you do stuff like that.
To go visit the property?
Well, no, not necessarily, just to walk the process, see what you're doing.
Yeah, well, I think
that, if that's okay with Dante as well.
I think when we do the walkthrough, I think we could all go and just walk together.
Yeah, that'll be nice. I mean, well, I think we need a lot more people that know, because I'm thinking about doing a 2-team, like having somebody that does know what they're looking at, Brad and someone else.
Like a home inspector type person, more so.
It's kind of, I mean, there are commercial inspection companies, because it's different than home inspection, but it's the same idea. I mean, you're you're looking in the mechanical room, you're getting up on the roofs, you're looking at the piping, you're looking at the electrical boxes in each of the units, making sure the wiring is correct. You're looking for water damage. You're looking for the general condition of each unit, like which ones have to be, and we'll have a clipboard and a spreadsheet, and we'll just be checking stuff off as we go. But that's our opportunity to do a real thorough, deep inspection of every unit. In addition, you have to do the lease audit, Dante. So we need to get the lease audit from these guys. And that's where we need to put it all in a spreadsheet and say, okay, unit 28 says they're paying $500 a month. Well, the bank account says $500 a month, right? And make sure we look through all the leases to see, are there any concessions that we don't know about or that the seller didn't disclose to us?
Right.
So that's the other piece of this due diligence puzzle. I don't know if Brad would help with that or not, or maybe, that's something you could do.
Yes, Brad is actually, let's see, I actually got an email from him the other day. I forgot to loop you into that bad boy. But let's see. Brad's going to be basically, it's going to help us with the operating and the CapEx budget. Then what's it called? Lease and occupancy verification, going back and forth on everything. And then the full financial underwriting to make sure that it's, make sure that we can actually, that it lines up to what they're giving us and what they said.
Yeah.
And if, hey, so we send it, we got someone else that's looking on top of it, sending that to the bank and then seeing what kind of loan they can actually give us. Because I really would like to push that thing up to get it to that express, because that bridge loan it's not scary. It's a little scary. Let's just say for right now. I wasn't thinking about a reposition like that.
You said it's a little scary?
Yeah, a little scary for, repositioning that, I was just thinking that we were going to raise it ourselves. But now we're putting that into the loan that, the bridge loan is a short-term loan, but then it has a CapEx budget inside of it too. And we're paying interest on top of that. I wasn't doing that up front. It was that we were raising the money to do the CapEx all in the raise in the 2.2. It was part of the 2.2.
Isn't the bridge loan just a percentage of the first couple of years?
A higher percentage of the it's a higher percentage
right
in the first couple of years. But being a bridge loan, they literally do the CapEx and they combine everything in it. So it's the bridge and the capital expenses.
So just so you know, I mean, I'm actually responding to Thomas right now, I think on Randall's deal, but I guess this would have, this would apply to both. Fannie and Freddie have really cracked down on their experience requirements, because they've been burned over the past 5 years of just kind of giving out loans to people who don't have any experience. I mean, you've probably seen all the news of the syndicators who have just gone belly up and blown up $50 million portfolios. But they have this, at the time of the application, at least one KP with control of the borrower has ownership and control in either a minimum of 3 multifamily properties with at least one for a minimum of the preceding 2 years, or at least one multifamily property for the 5 years preceding, or at least 10 units consisting of 2 to 4 unit properties for the minimum of the preceding 2 years.
Throw that in chat to understand that, bro.
What's that?
I have to throw that in chat to understand that. Yo, explain this to me like a 5th grader.
I know. Yeah, I'm responding to him because my only Cross Creek, my 90 unit deal in Carrollton was a Fannie Mae loan. And, I was a guarantor on that loan. The other ones, 600 units I was in the GP, but I wasn't a guarantor on them. But I don't think that's going to make a difference. We should be good. Oh wait, Dante, did you send the EMD?
Yeah.
Oh. Well, I just got it. Yeah. Okay, cool. I didn't realize you already hadn't sent it.
Yeah. Yes.
Got it.
Yeah, I had, man. I gotta get that thing out of my pocket. Get, you know, I don't want none of this money, man. It's going into the deal. I got issues. I got issues when money is in my pocket. So I signed it and I was just like, hey, man, we got to get that out. Get it out.
Yeah, there you go. There you go. The other kind of update that it would be for the benefit of the group, or, you know, Randall and I are working on this 16 unit in Jonesboro.
That's correct.
Yeah, and this is the issue with smaller deals, is that, you know, it's 16 units, so 2 vacancies push it below the threshold, you know, below the 90% threshold. So that's got to be managed very closely. And that's kind of what we're, because like at 2 units, it goes to 87.5%, 2 vacancies. So it's really random. We can only have 1 vacancy.
Correct.
You know, and so right now we haven't put that under contract yet because we're negotiating this occupancy language.
Yeah, I think he emailed you back actually. Well, at least I see him attach both of us on it.
Yeah. Yeah, and this CBRE Express loan that we're talking about, I didn't realize that their minimum loan was $3 million.
Mm-hmm.
And they said for Country Town Home, or why am I losing my mind? Country Club Town.
Country Club.
Yeah,
Country Club.
for Country Club, the reason why they were gonna make an exception there was because the price was over $5 million. Because they said they would like the loan to be $5 million or more, but it could be $3 million. Yeah, so Randall, I'm gonna respond back to Matthew. So the reason so you guys know what we're negotiating is, because we want to go agency financing and because occupancy is so important, we're asking for an occupancy contingency in the contract. And we're basically saying we don't have to close unless the occupancy is at 90% or greater. So you can have 1 vacancy. Now, it needs to be 90% occupied for 90 days. And so if we've got, you know, a 90-day contract, you know, how do we meet that requirement? Because it's not occupied now. We'd have to get it occupied. And then you can always request like occupancy waivers. And the fact that this property already has a Freddie Mac loan on it is good. It's a good fact for us. So we could probably get a waiver if it's occupied for 60 days. We'll have to just see. So yeah, Randall, I'll get back to him. I guess I ran that language by Thomas. Did I copy you on that?
Yes, I believe so. Yeah, I just was actually looking at it.
Yeah, and Thomas is like, yeah, that's BS, basically.
Yeah.
You know.
What did he say was BS?
Well, he said that link was from a mortgage broker without an agency license.
Oh, okay.
And then he gave us the SBL, small balance loan exception, which is straight from Freddie.
Exactly.
They'll still need to get an exception for sub 90 for the past 3 months. It's always a risk for an exception. Yeah, so I'll have to just send that to Matthew.
Okay.
Yeah. Awesome. And then Oscar, how are you going, man? I don't know if you can hear me. He's on mute.
I'm doing well, thank you for asking.
Awesome. And I think Oscar was kind of pivoting to, we still are going to have a call with this guy who wants to sell the mixed use property in Delaware, but it was a little, you know, oh, Oscar, did you have that meeting with the guy from Africa?
No. So he's hard to get a hold on. So I'm trying to set it up this week. Because he's moving back the following week, so I'm trying to get him sometime this week.
Got it. Okay.
But he's still adamant about investing, but it's just the time when he's when he's ready, I'll be busy or whatever. So the times just haven't worked out yet. So, but
Gotcha.
we're still trying to meet up though.
Got it. Okay. Okay. And then David Willis. David, how are you doing, man?
I'm doing all right.
Checking in, checking in. Yeah, David was looking at a deal in Detroit. You still looking at the Colonial Manor deal?
I don't think it's gonna work, man, because even the break even is 43%. We only had 43% occupied. We only had 39. So I'm gonna be running in a deficit until I get to 43.
Yeah.
I
Yeah.
don't think it's gonna work.
I agree. Yeah, it's a nice looking property, but it's and I can share my screen real quick because we were looking at this earlier.
The vacancy is just too low. I mean, the occupancy is just too low.
Yeah. Yeah, look, ain't nobody living there.
So I'm looking at some other ones.
Yeah, 39%. Did you run it through the Excel model?
Yeah, that's when after I checked it out, because we didn't discuss the break even. We knew the occupancy was low, but you told me to send them guys them questions. So instead of sending them questions, I ran it through the thing, and I seen that for me to break even, I need to be at 43%. So it's 39. So that means I would have to carry that for 90 days to get it to 43. It would only take, based off of what I was trying to do, and if things, went the way I foreseen, it would take 90 days to get it up to 43, but then you'd have to get it past there. So, yeah, it's just,
Yeah, that's a tough one.
yeah, man. Yeah,
But hey, I love the way that you thought about it, and you're not jumping at it. And like we've learned, we need to find a way or find a reason not to buy the deal. And if we got to carry it for 90 days to break even, and we don't have that cash now, and something like that, in a really distressed deal like that, we would ask the lender for an interest reserve, that we would put up. And that interest, or, the lender would fund a portion of it. We'd have to fund a portion of it. But that interest reserve would pay the mortgage for a certain period of time. And so the mortgage payment's not actually coming from the operations of the property, right? It's coming from the lender itself. And the reason why you do that is because that gives you time to get the occupancy up.
Yeah, but when I was looking at getting the occupancy up, you talking about interjecting it. It's gonna take an additional like $2,000 to push it. You know what I'm saying? So that's
right.
Even on top of, that's not even including, the reserve that we would have asked them for. It would have took an additional, $2,000 probably a month, or $2,000 every 60 days to push it, to get the occupancy up, to get the management in place, to get, to put the incentives and things in to get the occupancy up.
Yeah.
Check that out. I checked that out too. So that would have been an additional on top of that. I was looking at an additional, $2,000 just for that, on top of the deficit that we already running. That even at 43, that's just breaking even. So if that was covered, I'm still putting, 2,000 a month or 2,000 every 60 days to get for the incentives to get the occupancy up.
Right. Well, like I said, you're thinking about it the right way. This is how you analyze these distressed opportunities. And speaking of which, I've talked about some pocket deals. So I have been texting with the owner of ANS Capital, who's a big lender here in the Atlanta market, big family office thing down in Miami. And I got word, he has a bunch of distressed deals in Atlanta. And he sent me 1, 2, 3, 4, 5 addresses that we need to research and look at to see kind of just where they are. Here, I'm going to put them in the chat. I'm not, if you guys want to start. Oh God, can you see that? Oh Lord, that's small. But maybe if you click on it, yeah.
Hey Todd.
Yeah.
Matthew actually just called me. He stated that he was looking at your email response. He mentioned that he called up and spoke to a representative over at Freddie, and they stated that anything that was under 30 units, it can be at 85%. That's what he stated. He said he actually called in today. You said anything that was over 30 units, then that's when they kind of went towards looking for the 90. I actually told him to send it, just respond to that in the group message that we already had going.
Okay.
I actually see it.
Got it. Okay. Yeah, because Thomas Van Brunt, I guess I sent him, he asked me about my, the Fannie and Freddie experience. Like I said, they're cracking down a ton on that. Right. But they're going to run it by Fannie as well. And he gave us a soft quote, I guess LTV 70%. And this may apply to Country Club as well. 70%, fixed rate 7%. This is a bank execution. That means we got to put up personal guarantees. Interest only, an amortization, maybe a year of interest only, followed by 25-year AM, and then typically no prepayment penalty, and then full recourse.
Right. So it's no non-recourse.
Right. Yeah. So it'd be full recourse on our personal. And that's, but the idea is you get in there and you push it for 90% occupied for 90 days and, refinance it into an agency loan.
Right.
As quickly as possible. So we will look at that as well. But Johnny, kind of back to your original question. I know you guys are oh, here Matthew's calling me right now. He's on the ball, man.
Yeah, because I actually told him that I was on something else. So I didn't tell him that we was on the call.
Yeah. Oops. What was that? Oh yeah, they're talking about Synovus. Synovus Bank is the bank lender. So interesting. I may run it by Arbor. I mean, Arbor is just a pain in the ass to deal with, but they're one of the top DUS lenders as well. So I mean, we could just CBRE may be a little. They are very conservative, but let's kind of go with both and see if we get a better quote perhaps from someone else.
Right.
Okay. I mean, would you be opposed? I mean, Dante, would you be opposed to bank execution if required? Well, you're
all right. Say again?
Yeah. Well, I was just saying, like, if we had to go the bank execution route, which means it'd be full recourse.
Okay.
We'd have to sign a personal guarantee for the debt, but we also, it'd be a 7% rate, but the proceeds would be a little bit lower. Proceeds would be about 70% instead of 75.
Okay.
73. So we'd have to raise more capital.
Yeah. I think we can do it.
Yeah.
I mean, it's kind of something this deal to me is something that I really don't want to get away because of
I agree. Yeah.
It's just too sweet, and it's a once in a lifetime type of deal
Yeah,
I mean, I know we're
yeah.
gonna find another one, you know, sometime down the line, but golly, this is weird how this all
Yeah.
happened very quickly.
Yeah, yeah. Well,
So
I think let's just see what kind of term sheet we can get. I mean, with financing, you'll find out that it's really just, you put as many horses out there as you can, and you just see what you get back, and see who will execute on what.
yeah, and I've sent it off to two other I sent it off to another M&T, and then I sent it off to another broker. I talked to a broker, a loan broker on Saturday. He said it went right up under the threshold for equity partner. So their equity, they don't want to do anything less than $2 million. And he said anything over $2 million, they want to, that's the smallest equity partner that wanted, they'll
Wait, when
give
you're
us an
talking
equity
about, you're
check.
talking about a loan or equity to invest?
Oh no, that's what I'm saying. With equity, he was equity to invest, with nothing less than two. He was. That's the only thing because our deal is too small for anything else he was talking about.
Oh, okay.
So, but I sent it off to another guy that's in New York. I've been talking to him for a couple weeks now, and he's a pretty good guy. He's been asking me, so I just sent off the numbers to see what he can maybe do for us that might be different than CBRE.
Yeah.
So I just started shopping it out probably this weekend.
Yeah, let me
just 'cause we're getting
run
close.
it by Joe Chernesky at Arbor as well. Arbor Commercial Real Estate Lending, like I said, they're just kind of dicks, but they're good at what they do. So let me get them on the horn as well.
Okay.
All right. Anything else for the good of the order?
Mm,
Good of the group?
think we're good.
We're good.
I'm
All
good.
right. Sounds good, guys. I'll keep pumping stuff out there, and I'll be on Telegram, and I'll see you on the calls.
All righty.
All right.
All
Take
right.
care, guys.
Sounds good.
Bye.
Appreciate it.